Good afternoon, everyone. This is Hamilton Rodrigues here at the Outsiders Podcast with a special guest, Richard Zaccarro. Richard, how you doing this afternoon?
Good, my friend. How about yourself?
I'm doing okay. Um,
Good.
I got wind of you writing a book a while back, and I
Yes.
took a look at this wonderful book. I'm gonna put it on the screen here.
Right.
In God We Trust, investment business, not so much, by Richard
Correct.
Zaccarro. Richard, tell us a little bit about yourself and what inspired you to write this book.
Well, I've had an extensive background in the investment industry. I was a young man. My hair was a lot more black than it is gray now. And I started off my career with the state, the Commonwealth of Mass. I was fortunate enough to run the state pension fund, the $5 billion state pension fund. I'm just going to grab my dog real quickly here. Buzzy, he's got to be with me constantly. And I went from running the pension fund. It was a $5 billion fund when I left. We laid the basis and the groundwork for that. And today it's a $65 billion fund. We had one of the largest unfunded pension liabilities in the country. It was 12 billion unfunded pension liability back then. And we were restricted to a very conservative list of investments, bank stocks, railroad stocks, and fixed income securities. So we had to go before the state legislature and ask them to allow us to address the $12 billion unfunded liability by getting more aggressive and fully allocated with our investments, which they did. And we fully diversified the system. And now that unfunded liability is way down. I believe they're about 80% funded now, the state pension fund, thanks to our groundwork that we laid. That was 30 years ago. And right now it's a $65 billion system. So that shows you the compound effects of proper investments with a diversified fund that accounts for asset allocation, accounts for 90% of your investment return over the years, 30 years cycles. So when I left the Commonwealth of Mass, I became a global investment money manager, marketing for an international firm, equities and fixed income, called Standard Chartered Bank out of London. And the investment division was the Equator Group. I was there for about 2 years, and then I became a consultant. So I have about 30 years experience in the buy, sell, and consult side. So I was a pension fund consultant for 3 different firms for about 15 years. And then I decided to start my own business. That was a third-party marketing company. I represented institutional managers throughout the world and sold to pension funds. That lasted about 10 years. And I said, I had enough. It's time for me to write a book, which I did, based on my experience and some of the fundamentals for investment people to follow. And now I'm semi-retired. I golf a lot with my grandson, and I hang out with my dogs and my family. And I work at a golf course part-time right up the street from my house in Walpole, and play as much golf as I can while I'm still able to play.
Wow.
So that's basically it in a nutshell. Covers a lot of years.
Yes, yes. But we're gonna have a formal interview slash conversation in a couple of weeks, and
hmm
have a more in depth conversation about this book. But can you just give us like a brief synopsis of why this title, "In God We Trust"? The
Yeah,
investment business, not so much.
by the way, I sold copies all over the world, in Japan and China, England, a lot of countries. And I asked my son, who's pretty artistic, to design that cover. I was going to design something a lot less, a lot more conservative, put it that way, and less fancy as he did, kind of shocking. But he said, no, 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 you need something that's going to catch people's eyes. So
Mhm.
I said, have at it. He's pretty good at the computer and artwork. So he designed it. And the significance of that, you can see Wall Street in the background, and then he put in a Greed Street. You have Benjamin Franklin covered with $100 bills uh, nailed to the cross.
Mhm.
And you can see on top is that insignia is calling, it's on a dollar bill, by the way, the pyramid with the eye on it. And the significance of that is they're calling for a uniform monetary system that we may see one day. I know Europe has a euro dollar, and one of these days, I think they're going to call for a uniform monetary system.
Yeah.
So the significance is Ben Franklin, that's on the $10 bill, atoning for the sins of Wall Street by getting nailed to the cross. So he figured that was going to be a big seller, and it is eye-catching. And if you go on Amazon.com, Amazon Books, you can get it in a paperback copy. I believe it's like $9.35, something like that. Or you can go on Kindle.com and get the electronic version for much cheaper, like $3.50 a copy online.
Yes, yes.
And you can read the reviews. There's about 15 reviews out there. I mean, some of the reviews are from my personal friends after they read the book, but it talks about the basic fundamentals of investing. And I kept it in layman terminology. I don't want to get too complicated. So the average person will have no trouble understanding that. And I also talk about my personal experiences in the business. So it's part autobiography and part tutorial. And then I talk about some of the scandals, and there's plenty of scandals that I've witnessed over the years in the investment business. The one, probably one of the largest ever, obviously, was Bernie Madoff, the hedge fund manager.
Yes,
You know, and ironically, all investments called to be audited, and the hedge funds were one of the few asset classes that weren't required to be audited. So there was a tremendous, he would never got caught unless there was a run on the money when the economy, the bubble burst, people wanted their money back.
yes.
And he didn't have it because it was a Ponzi scam he was running. So he would, let's say, borrow money, you'd invest money with him. He'd take the money that you gave me to invest, and he would go to someone else and borrow money off of them. Then with their money, he'd pay back you a stipend here and there, showing you were making good returns. And no one was complaining because they were making really good returns until the bottom fell out. And then everyone wanted to redeem their funds, and he didn't have it. And the rest is history.
Yes, yes, yes. So that's going to be an interesting conversation we're going to have at the actual interview / conversation in a couple of weeks that we're going to prepare for.
Yeah, I'm looking forward to it.
Yes, I don't want to release too much juice about this book. And,
yeah, I'll give the basic investor out there some wonderful tips. And I always said in the back cover of my book, I don't know if you can see that, but I got some lines there, and pretty interesting lines. How, you know, I went making nothing to hundreds of thousands of dollars back to nothing. That's how volatile the business is.
Yes, yes.
And it's not rocket science. It's just fundamental investments.
Yes, yes, yes. Well, it's interesting that you said that it's not rocket science. It's about investments. But the topic of this show that I wanted to talk about today was why mortgage rates remain high despite Federal Reserve rate cuts. And you came about with this book, and I said, Richard, come on the show today and let's talk about interest rates and Federal Reserve rate cuts and so on and so forth. Because I think you can give a better synopsis than I can about why this is happening. Why, when they say when the Fed say we're lowering rates to 4%, how come the rates, the mortgage rates, are going higher, in your opinion?
Well, it takes time. Some of the big economic indicators, obviously, is CPI. What CPI rates doing over there? Supply and demand. What's out there? Is you being a real estate expert and advisor, you know that, you know, if there's scarcity determines demand and price. So the fewer houses, the higher they go.
Yes.
And I always like to say the first indicator is usually in the economy, what people are doing, what are they buying. And the mortgage industry, it's kind of more of a trickle down effect. So there's more time lag involved.
Yes.
So sometimes it might take, 6 to 12 months before you really know what's going on there. But I'd like to start off with a little bit about the federal tools, the Federal Reserve tools, what they use to control the economy.
Mm-hmm.
So I was an economics major, was a great base for my investment career, and I encourage anyone that's thinking about getting into the career. In my book, I highlight, what courses to take, what to do, what licenses you need, the different aspects of the business. If you're good at sales and marketing, and you want to be a portfolio manager, if you're better at numbers, etc. But basically, the federal tools are two tools they use, three tools: fiscal and monetary policy, and also the printing of money. So they use interest rates and money supply to affect the economy, and they use the supply and demand, which drives prices. So the higher the interest rates, they want to slow down the economy. If inflation is kicking in, they want to higher the rates, which encourages people to take their money out of the economy and to invest it at a better rate of return.
Mm.
And also it removes, surplus money from the economy. Now, the opposite effect for recession, what they want to do is they want to lower the interest rates, which encourage people to borrow the money and stimulate the economy, allowing people to access money at a better rate. So what do? They go out and get mortgages. They may refinance their existing debt on their home. They might take out home equity loans. And then they kick in the money, the printing of money, which can really trigger inflation. So when they print money, what they do basically is they're allowing a lot more supply to loan out to the banks to allow people to borrow money from the banks. So that's basically what the feds use for tools. So getting back to your question, when they lower the interest rates, it's going to take time. I know the rates were not too long ago. They were fairly high. They were up to 8% for 30-year rate. Now I
Mm-hmm.
think they finally lowered it down to 6. So there's a lag effect that I described when I first mentioned that. So it's going to take a while, but eventually that will stimulate the economy and the mortgage industry.
Yes, and what we forgot to mention was short-term rates and long-term rates.
Right.
You
Yeah.
know, in the short-term rates of the credit cards, the personal loans, and
Right.
the small loans, but the
Right.
mortgages are more long-term rates.
Right.
So there people get those two confused.
Yeah, I think the president was even talking about car loans too, extending the length of a car loan. Usually
Mm-hmm.
car loans are like, out to 3 years, but he was talking, stimulate the car sales, putting a rate out there for 10 years on a car.
Mm.
I mean, you're going to spend a lot more interest, but they'll be more affordable.
Yes, yes, yes.
And you have a 15 adjustable arm mortgage rate if you want to really pay off your mortgage.
Mm-hmm.
But you kind of committed to it. Then you get the 30-year rate, but you can also get a mortgage. I would suggest getting the 30-year for lower rates. And then if
Mm-hmm.
you come into some money, you can pay it off. I don't think there's any penalty to pay it off early.
Yes, 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 yes. But then, like you mentioned before, inflation plays a big role as far as pricing is concerned because the what ifs, and just because the Fed say it's 4% this year, um, the bank has to protect their back end, so they're not going to put it at 4.5. They're going to put it at 6 or 7
Right.
because of the what ifs.
Yeah, yeah, they absolutely they'll make money off of the money. It always amazes me with the financial institutions. They're borrowing money at such a low rate, and then they loaned it out for a much higher rate.
Yes, yes,
But why don't they give people, a better interest rate to encourage them to invest in their bank?
yes, yes, yes.
You know,
But it goes
and
back.
being in real estate too,
Yes.
that part of the problem, what drove prices, is there was supply. There was no supply on the market. It was very limited.
Mm-hmm,
So, I
mm-hmm.
mean, if you're, let's take Brockton, your typical home in Brockton is probably assessed now for maybe $500,000, let's say, a little
Yes.
less, 450.
Mm-hmm.
So, as a broker yourself, you know the deal. When people come in, how many potential buyers are bidding 50,000 more than the asking price?
Yes, 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 exactly.
And the market price is a lot higher than the assessed value too. So your home
Hmm.
could be assessed for 461,000 with the city or town that you're getting taxed on, but uh, in actuality, it's probably worth 50, 100,000 more market value.
Hmm.
So it's based on supply and demand, what people are willing to pay for a house.
Hmm. So back to your book. Does your book talk about mortgage-backed securities or
Briefly, it
briefly?
does. Yeah, briefly.
Hmm.
I have, if you look at the chapters in my book,
Hmm.
I don't know if you have a copy with you or the
Hmm.
index.
Hmm.
Chapter one is background and the start of my career in state government. Chapter two is the start of my career in I call it the so-called dreaded private sector.
Hmm.
Number three, the start of self-realization, being self-employed in the ins and out of the investment business. So I talk about that. Then
Hmm.
chapter four is very interesting. I have some good charts, building your portfolio to achieve optimal diversification.
Hmm.
Chapter five is a different styles of investing. And
Hmm.
chapter six, where my prediction where the industry is headed and what needs to change moving forward. That I'll talk about. I was pretty accurate because I wrote this book in 2014.
Hmm.
So, 12 years later, we can talk
Hmm.
about some of the trends that I predicted
Yes, yes,
that have happened.
yes.
But I don't get into detail in mortgage backed securities.
Hmm.
But I list all the different type of bonds and the returns. I also in the back have a chart of the different prices, what you expect to pay in
Hmm.
fees, basis points for mortgage-backed securities, corporate bonds, junk bonds,
Hmm.
government bonds, treasury bonds.
Hmm.
The more aggressive you get in your investment, the more return you'll get. However, you'll also be exposed to a little more risk of default and what have you.
Hmm.
I remember everyone probably knows the name Michael Milken, who he was.
Hmm.
He was the junk bond king that ended up doing time,
Hmm.
selling all those junk bonds of his. And a lot of them defaulted when the economy went south
Hmm.
in the financial crisis. But
Yeah.
he was the bond king.
Hmm. So, Richard, if someone wants to purchase your book before our next
Yeah.
interview, where can they go to purchase your book besides Amazon? I know they can get it on Amazon at any time. It will be delivered to their doorstep. But where else can they find this book if they want to purchase it before?
Well, right now, since it was written 2014, at one time it was down Barnes and Nobles. Actually, I did a book signing down there in Walpole
Mm-hmm.
few years back. But right now, I believe the only way they can purchase this book is online on Amazon. It's probably the cheapest price too.
Mm. Okay.
Yeah, and I'd encourage everyone to look at some of the reviews. If you Google the book's name, Amazon Books, they'll show the preface of the book, and you can see all the reviews, what people have to say about it.
Okay.
I mean, I'll talk real quickly about, I said before, asset allocation. That's where you invest your money. And the old adage is you don't put all your eggs in one basket because if that basket drops, it's
Mm-hmm.
going to be shattered and you'll have no eggs left.
Mm-hmm.
Well, that accounts for 90% of your investment return over the years.
Mm-hmm.
And what happens, some of the mistakes people make, the basic investor, they're not diversified enough. They try to time the market. And there's an interesting statistic over like 10-year periods. If you were out of the S&P 500,
Mm-hmm.
I mean, S&P 500 for 5 days, I mean, it can seriously impact the return by 10% or more. Just
Mm.
being out of the market 5 days. So you don't want to try to time the market. There's not too many market timers are successful in that business.
Yes.
And also, you don't want to get overly conservative. I mean, unless you're a multi-millionaire, you can put all your money in U.S. Treasuries, which is
Mm-hmm.
probably the safest investment.
Mm-hmm.
If you're really wealthy, you go for tax-free municipal bonds that are exempt federal and state tax, and that gives you an added kicker on return when you're not paying taxes. But you don't want to get overly conservative because what happens over the years, inflation, CPI erodes your investment earnings.
Mm.
So by the time you retire, you don't have enough money to live. Why
Mm.
a lot of people are going out and getting part-time jobs.
And that's a big growing issue nowadays.
Yeah.
Inflation.
Overly conservative is not good. So we'll talk when we talk about the book. We'll talk about the optimal level, which is called the efficient frontier.
Mm-hmm.
So you'll have like fixed income pays a certain return. Large cap equities pay a certain return over the years. Small cap, a little more aggressive. International small cap, really more aggressive. Then you go into the private equity, venture capital. But probably the best investment avenue is real estate, which you're in, because you not only get appreciation in the equity market over the years, but it's a great hedge against inflation, and you
Mm-hmm.
can write off a lot of expenses too
Mm-hmm.
on the house as you do repairs and whatnot. So it's the typical asset allocation for a pension fund. We call it like a barbell effect, like
Mm-hmm.
weights with a barbell with weights on either end.
Mm-hmm.
So on the left side, you get more conserve, you get fixed income securities, and that's for income, incremental income
Mm-hmm.
to pay out some of your liabilities. And then in the middle, you have your plain vanilla stuff, your smaller, I mean, your larger cap, S&P 500, blue chip stocks,
Mm-hmm.
conserve, good return. Then you get a little further out into national investments. There's more risk because you don't know what's going to happen in other countries.
Mm-hmm.
And then in the end, you get the really gunslinger investments, I call them. They're going to give you high return, venture capital, private equity. But
Mm-hmm.
I mean, you got to be careful because you every private equity manager, he's going to have a few home runs in his portfolio, and he's going to have a few dogs in the portfolio that will lose money.
Mm-hmm.
But on average, they give you a pretty good rate of return, but there is more risk associated with that.
I understand. I understand. So, Richard, you are not only a book writer, you're a financial guy, numbers guy, but you're a community guy as well. And I didn't introduce you as such when we first started the podcast. But tell us a little bit about your past, community wise, political wise, just to give people a
Yeah,
brief synopsis of what you have done in the past, community wise.
right. Well, I've always been involved with politics and government. Don't forget, I started my career off. I was a young man. I was back in, let me see, 1978 when I got married. I worked for the state. I had the pleasure of working for Robert Q. Crane. He was a great state treasurer. He built the lottery, cash management, abandoned property. So I had a love for government, and I served on many committees over the years. From Brockton originally. Spent 62 years of my life in Brockton, City of Champions, Rocky Marciano, Marvin Hagler, good sports program. And then what I did, I served on like the Cable Advisory Committee, negotiating $1 million contracts with cable to get money back to the community. I was chairman of the Mayor's Trust Fund Commission. We grew that from like 1.5 million to 10 million by diversifying the funds like we did with the pension funds. Then I moved to Walpole. I ran for office like yourself several times. Not too successful over the years, especially
Yeah.
in Brockton. However, when I moved to Walpole, I finally got elected as a representative town meeting member. And then I get elected. I'm doing my second term as a tax assessor board member.
Mm-hmm.
So I've always been involved with politics, helping the people out in the community. I've been a big advocate for lower taxes,
Mm-hmm.
and we started Brocktonians for limited taxation. That we had about 250 people in that group, and we protested in City Hall saying they're killing us with taxes. So I wasn't the most popular guy with the politicians, but they did respect me because they knew I knew what I was talking about. They couldn't pull the wool over my eyes, as they say. But I don't know if I'd win a popularity contest with them. And that's probably why I never got elected in that city. You're familiar with that,
Yes, indeed.
as we have a lot of common background, you and myself. That's why
Yes,
we became good friends.
yes, indeed. So I don't want to give too much more juice, but if there's one thing about your book that you would like to point out that highlights this entire book, what is that one thing, Richard?
Well, I'll break it down to two things. One, it's a tremendous experience for someone to get into right out of college. I mean, I had a wonderful time. I traveled the entire world, ate at the nicest restaurants, played the nicest golf courses, but it's like the major leagues. In that business, you got to produce, and if you don't, you're out. Simple as
Mm,
that. So that's on a personal note. What is my favorite subject in the book? Now, as far as investments go, I think it's what I said earlier. There's really three keys, and the biggest facet is diversification. I can't stress that enough. You could have the. I have a quote on the back of my book that you can have the best managers in the world. However, if you're not diversified enough
mhm,
properly, then you're not going to get the return you're looking for. So what we do, if you were my client and said, "Hey, Dick, what should I invest in?" So first of all, I'd sit down with you, look at your income, look at your liquidity needs to pay your bills, look at what you want to do, look at your risk factor. So we do what they call an asset allocation analysis for you. Now, asset allocation is based on like 30 years of past financial results. And then there's always an asterisk. We used to tell our clients, we can't guarantee you're going to do this, but here's a probability study based on past returns. However, make sure you understand this. Past returns are not indicative of future returns.
mm,
A lot of things can happen during the interim, but we would give you like 6 different asset allocations. We'd say, oh, look, Hamilton, we can almost 1 year out, you get a certain percentage of getting this return. Like, let's say we put everything together, all these assets to project a 10% rate of return that you're looking for. So
mhm,
the first year, you may get a 1% chance of getting 10%.
mhm,
Second year, you may get 2% chance, all the way up to over 30 years. When you hit that 30-year benchmark, it's 95% almost certain that you're going to get that investment return. So what am I saying here? Duration affects volatility and smoothes things out.
mm. Plain and simple, short and sweet.
Yeah, like I say, it's not rocket science. This is
Yeah.
rocket science. Nothing like Elon Musk is doing. He wants to put a colony on the moon or Mars.
Hey, there's a
We're
shortage of
com-
housing. Why not?
yeah, we're competing with China on that one. They say China's almost ready to go to the moon now and build a colony. It's like Star Wars all over again.
Exactly.
But I mean, it's pretty basic, and we can go through the charts and everything else, and
Mhm.
the next time we talk.
All right. So thank you, Richard. And we all look forward to talking to you, Richard.
I look forward to him. By the way, this is my 12-year-old Yorkie Buzzy. He always has his tongue hanging out of his mouth because unfortunately we had his teeth removed a long time ago because Yorkies traditionally have bad gum disease and teeth, but he's a sweetheart.
Yes,
Follows
yes,
me, he's like my shadow, follows me around everywhere. Follows
yes,
me around everywhere.
yes, indeed. We all look forward to meeting with you again.
Well,
And
thank you for the time, and I look forward to coming back on your podcast, my friend. You do a good job. I see all your ratings. You put out a podcast, I see you get like thousands of hits right away. So hopefully, we'll get the same results of this.
yes, 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 yes.
Yeah.
But hopefully, folks would take their time to buy the book on Amazon and
Yes.
read it before the next episode, and hopefully it'll be enriching.
Yeah. Now, do you have the capabilities of having anyone call in your show or
Uh,
text you
well,
questions?
they could direct message me on Facebook, and if they
Yeah.
have any
Okay.
questions, so DM me on the Facebook page, and I'll answer any
Yeah.
questions you may have, where to buy the book, and so on and so forth. But in general, you can buy the book on Amazon, and
Hmm.
it's going to be an interesting read, and it's going to be an interesting show in a couple of weeks. Okay.
Sounds good, my friend. Thank you so much.
All right. Thank you, Richard.
Have a wonderful day, everyone out there. Stay safe. God bless.
Amen.
Take care now.
Bye.
Bye, Buzzy. Buzzy.